Welcome to this explainer. Today, we're diving into what is honestly one of the most fascinating accounting mysteries out there. I want you to imagine this. You're the CEO of a manufacturing company. Your production team builds the exact same number of units, and your sales team sells the exact same number of products. Yet somehow, your finance department hands you two completely different profit numbers for the year. I mean, how is that mathematically possible? Well, it all comes down to an epic battle between variable costing and absorption costing. So let's solve this mystery. Okay, here's a quick look at our agenda. We'll be moving through 1. Foundations of business costs. 2. Variable versus absorption costing. 3. Calculating cost per unit. 4. Why profits can differ. 5. Reconciling the profit gap. And 6. Making real business decisions. Section 1. Foundations of business costs. Right, before we can figure out our shifting profit mystery, we have to lay down the absolute foundational rules of how costs actually behave. I want you to picture a literal inventory cost basket. According to international accounting rules, specifically IAS 2, only certain manufacturing costs are allowed to go into this basket. These are your product costs, and they sit there as an asset on your balance sheet until you actually sell the item. Everything else, those are period costs. So the assembly workers' wages, they go right into the basket. But the CEO's massive marketing budget, that gets kicked straight out of the factory and is immediately expensed on the income statement for that period.
Now, costs also behave differently when your production volume changes. This is absolutely crucial to grasp. Variable costs, like raw materials, go up proportionately as you make more stuff. Fixed costs, like a $10,000 a month factory lease, well, they stay exactly the same whether you make one single unit or 1,000. We've also got semi-variable costs that kind of mix the two, and step costs that stay fixed until you hit a certain capacity, and then boom, they jump up because you had to, say, rent a second factory.
And that brings us right back to our central problem: identical production, identical sales. Two totally different profit numbers. If the physical reality of the business hasn't changed at all, how on earth can the financial statements tell two completely different stories? Section 2. Variable versus absorption costing. The answer to our mystery lies in a heavyweight clash between two radically different costing systems. In the left corner, we have variable costing, which is heavily favored by internal management for quick decision-making. And in the right corner, absorption costing, the undisputed champion of external financial reporting. They are looking at the exact same factory, but they treat manufacturing overhead in entirely different ways. The whole philosophical divide boils down to how they handle fixed manufacturing overhead. Think factory rent or machine depreciation. Absorption costing physically absorbs these fixed costs straight into that inventory basket we talked about, tying them directly to the product. Variable costing, on the other hand, argues, hey, factory rent is a cost of the period, not the product, and expels it directly to the income statement as an immediate expense, regardless of how much inventory you actually produced. Section 3. Calculating cost per unit. Let's look at the mechanics of this. Building a product cost is kind of like following a recipe. Step 1, direct materials. Step 2, direct labor. Step 3, variable manufacturing overhead, like the electricity running the machines. Now, both systems agree completely on these first 3 steps. But look at step 4. Only absorption costing adds that slice of fixed manufacturing overhead to the unit. Because of this one extra step, if your fixed overhead is allocated at, say, $2 a unit, your absorption unit cost will permanently be $2 higher than your variable unit cost. But there's a practical wrinkle here. We can't sit around waiting until December to get our actual factory utility bills before we price the goods we sold back in January. Because we literally don't know the actual bills until the year ends, we have to use budgeted overheads, estimated rates, to make our day-to-day costing and pricing decisions. And since reality inevitably refuses to match our budgets perfectly, we end up with a discrepancy. When the actual bills finally arrive, we might find we applied way too much cost to our products, or maybe too little. This creates under-recovered or over-recovered overheads. It's a variance that we absolutely must adjust for in our final profit calculations just to keep our records accurate. Section 4. Why profits can differ. So, now that we know how these costs are built, we can finally crack the case of the differing profits. If you look at the structure of their statements of comprehensive income, the divide is super clear. Variable costing subtracts all variable costs to highlight the contribution margin, showing you exactly how much each unit contributes to covering your fixed costs. Absorption costing, meanwhile, focuses on gross profit, subtracting the full cost of sales. Because absorption costing splits that fixed overhead between the units you sold and the units left sitting in the warehouse, the profit numbers completely diverge.
As accounting legend Colin Drury points out, neither of these methods is inherently wrong. They just serve completely different masters. Management absolutely needs the contribution margin to see if a product is actually viable to make. But external shareholders and tax authorities, they need absorption costing to make sure inventory is fully valued according to the rules.
Section 5. Reconciling the profit gap. To prove that neither system is broken, we can mathematically bridge the gap between them. And the math here is actually incredibly elegant. It proves the entire profit difference is literally just the fixed overhead getting trapped inside your warehouse inventory. If you take your variable costing profit, add the fixed overhead temporarily stored in your closing inventory, and then subtract the fixed overhead released from your opening inventory, you will arrive perfectly at your absorption costing profit. And keep in mind, under IAS 2, your choice of inventory valuation method, like FIFO or weighted average, will further manipulate how those accumulated costs flow out of the warehouse and onto the income statement. FIFO assumes your oldest costs hit the income statement first, while weighted average smooths everything out into a blended rate. This ultimately dictates exactly when those trapped overhead costs hit your bottom line. Section 6. Making real business decisions. Okay, so we've done the math. But why does understanding this highly technical accounting gap actually matter in the boardroom? Well, it's absolutely crucial for everything from compliance to actual company survival. Absorption costing is legally required for external reporting, for sure. But using it internally, that is a massive trap. It can distort your pricing by arbitrarily spreading fixed costs around, which might accidentally lead managers to drop highly profitable products. Plus, from an audit perspective, because absorption costing ties fixed costs to inventory, a manager could artificially inflate their company's profits just by overproducing inventory they haven't even sold yet. Think about that. It's a totally wild accounting loophole. Let's piece this whole puzzle together one last time. Understanding your cost behavior dictates your cost assignment. That assignment has to adhere to IAS 2 inventory rules. This drives your choice between variable and absorption costing, which then ultimately defines when your profit is realized. And all of that directly impacts the managerial decisions that determine the success or failure of your entire business. I'll leave you with this final thought to ponder as we wrap up this explainer. Think about that manager trying to hit their targets and boost their bonus. If your reported profit increases just because you built up a giant mountain of warehouse stock that hasn't even found a buyer yet, are you truly generating value for the company, or are you just playing the absorption costing game? Keep that in mind the next time you look at a bottom line.